After two volatile sessions, the crypto market enters the new week balanced between recovery and renewed caution. Bitcoin's rebound above $115,000 restored short-term confidence, while Ethereum's 9% climb signaled that buying interest has not disappeared. Yet questions remain: was this the start of a sustained stabilization, or merely a technical bounce inside a larger correction? The answer will depend on how liquidity behaves during the next few days. First, support and resistance levels have become clearly defined. For Bitcoin, 105,000 to 110,000 forms the near-term support band, while 115,000 to 120,000 marks the resistance zone. If prices remain between these levels with gradually rising volume, it would indicate controlled consolidation, a base building process after the shock. A decisive break above 120,000, however, would re-establish upward momentum and invite technical buying. Second, derivatives markets still hold the potential to influence direction. With billions in Bitcoin and Ethereum options set to expire this week, hedging flows may either reinforce or dampen the recovery. A decline in open interest combined with stable funding rates would confirm that leverage has normalized, reducing the risk of another cascade. Third, institutional behavior remains the silent compass. ETF inflows continued through the recent turbulence, implying that large investors still view crypto as a long-term asset class rather than a short-term trade. If these inflows persist, they can anchor sentiment even in the face of macro uncertainty. Fourth, the macro environment remains the wild card. Recent trade policy announcements and a stronger US dollar introduced friction across all risk markets. Any sign of easing rhetoric or softer economic data could quickly restore appetite for digital assets. Conversely, renewed tension or stronger dollar moves could limit upside momentum. From a technical perspective, several indicators suggest a market in transition rather than in distress. The relative strength index for Bitcoin has returned to mid-range levels, neither overbought nor oversold. Momentum oscillators show flattening rather than continuation of decline, and intraday volatility has begun to contract, early signs that selling pressure may be losing force. Fear and greed indexes hover around balanced readings, and exchange inflows have not increased materially. Traders appear cautious but not fearful, waiting for confirmation before committing new capital. Sentiment data reinforces this neutral stance. For long-term observers, this moment underscores the difference between trend and noise. Corrections can erase gains but also reveal where conviction truly resides. If this rebound survives the week without retesting recent lows, the structure of the broader uptrend remains intact. If not, the 95,000 region stands as the next meaningful support to watch. The broader narrative is unchanged. Blockchain adoption expands, institutional frameworks strengthen, and infrastructure development continues regardless of short-term price movement. These underlying forces shape the market's long-term resilience. In the immediate term, the focus should stay on data, not emotion. Liquidity, volume, and macro tone will determine whether stability becomes sustainability. Either outcome, consolidation or continuation, moves the market toward equilibrium after last week's stress. Markets do not rise on enthusiasm alone. They rise when confidence returns quietly and broadly. The coming days will reveal whether that confidence is rebuilding beneath the surface. For more insights on Bitcoin, Ethereum, and the forces moving the crypto markets, remember to like, subscribe, and keep learning, here at Crypto in Black and White.